The PPI numbers are really complicated, JD, and I think it's hard to pull out a singular narrative from them as a result. But what we are seeing when we look at the numbers for September based on what we knew back in March when PPI hit the highest levels or near to the highest levels on record, we are seeing moderation in terms of factory gate inflation, and that is absolutely a good thing for corporate America because it allows for margin expansion, or probably in the case of most companies, a relief in terms of margin compression. But I think more troublingly, JD, is the fact that we are seeing inflationary pressures more deeply embedded into components at the factory level than we first anticipated. And by that, I mean, in terms of the rising costs of producing services as well as goods, we are seeing these embedded cost pressures, which are lifting both headline and core producer prices. That does suggest that those very same pressures are likely to be embedded into the consumer economy as well. And therefore, that will probably mean that inflation stays at elevated levels for longer than we are currently anticipating. This might explain why the Fed has been so insistent that it hasn't made any progress on inflation as yet, even though we saw some moderation over the summertime in CPI numbers, and why they feel that they need to take the Fed funds rate to that elevated 4.5% level, or perhaps even beyond, for a longer period into 2023, even if it means, as is currently the case, a shallow or maybe even potentially deeper recession for the US economy. The Fed is seeing what we are seeing, and as a result, I think they are worried, and we are becoming worried along with them, that inflation is finding itself more embedded into the economy than we first assumed even a few months ago.